And I see someone is really trying to test me here with Section 199A. I feel like I'm on the hot seat with my, my tax professor or something.
So, welcome this morning to today's free webinar hosted by me, Tom Alston of Aero Marine Tax Professionals. The guest speaker today is Nate Pietila of Aero Law. I've often heard him described as the most brilliant and smartest aviation tax guy, and that came from a guy who at the time was the number one guy at Aero Law, but has since moved on pleasantly to living life on his boat. And so welcome to today's webinar. I want to let you know that we're also on live on Instagram and Facebook, so we have plenty of people on. If you have questions, please go into the chat box and type them, and then Nate will get them. And we both encourage you to interrupt us. As soon as you have a question, ask it. Don't try to hold it to some later period, because that question is going to be relevant to whatever Nate's talking about at the time. Our normal process is, the first thing I'm going to do is I'm going to play you a little video from our company, and this is a client testimonial that we recently did.
A good team. The whole team was great. My name is Ron Wright. I'm the owner of Catalina Imaging. We're a mobile CT scan provider. We rent CT scanners throughout the United States to hospitals. I purchased an airplane in 2014 to assist me in the course of my business so I could get to more remote hospitals quickly, service my customer base better. So it was just a matter of great convenience and customer service that led me to make the aircraft purchase decision. My introduction to Aero Marine came about as a result of working with various aircraft brokers. When I was looking at the original purchase of an airplane, I was introduced to Aero Marine through one of the brokers, presenting the opportunity of where we might be able to save some money, because most of our flying is not within the state of California. It's all over the West Coast. Tom was very helpful, very friendly, and made the process simple to follow, broke it down into a number of steps to take, and we just followed the procedure, and everything just kind of fell into place. It wasn't difficult at all. I worked with Julie as I was building flight history, and Julie was very helpful in guiding me what to do and how to do it. So she was always available if I had a question. I appreciated Julie very much. Throughout the process of building flight history and building the presentation package that would be presented to the state, I had no problem getting any questions answered along the way. They were very responsive and helpful. When the exemption letter came, it was a bit of a state of shock. It was both a combination of what I expected, but it was also an affirmation that this was a good choice, and it just worked out very well. I anticipated there would be more questions or more problems that we would have to address, but none of that took place because we had all of our ducks in a row thanks to Tom and Julie. I think the greatest surprise with Aero and Marine was their approachability. There was never a stigma, an arrogance, or a delay in any communication. Everything was prompt, dealt with right away. I appreciated their ease of just simply taking my phone call if I had a question. It was very good, better than I expected. I would very strongly recommend Aero and Marine to anybody with an aircraft that they are purchasing. The process was simple, it was very effective, and I would highly recommend them.
For those of you who are on Facebook Live, there was our phone numbers. So now we're going to get into the live presentation. Take it away, Nate.
Good morning, everybody. Nate Pietila, Aero Law Group. Thank you, Tom, for setting up this webinar. Thank you, everyone, for attending, and hopefully I can bring you up to speed on kind of the new tax regime that we have that affects aircraft, mostly generated by the Tax Cuts and Jobs Act, passed not quite 2 years ago. It's created some interesting situations for aircraft owners, and I hope you all find it useful. So there's a number of slides in this presentation, and if you need a copy, we can provide that to you. We're not going to have a chance to get through all the slides today, but we are going to start with aircraft income taxes and continue with probably just through part 2 on multi-state sales and use tax. Probably won't get to part 3 during this webinar today. We describe what we do as aviation attorneys as kind of a big game of whack-a-mole. There are a lot of little critters we consider all the various legal regimes and rules that pop up to be little critters that kind of dig holes in your yard, and you've got to deal with them somehow. And on this slide here, you can see there's just a ton of different things that we deal with. We deal with IRS issues, we deal with insurance issues, and we actually deal with multiple different IRS income tax issues. We deal with state property tax, we deal with the FAA. Maintaining regulatory compliance there is very important as well. And if you're a public company, we also help you through disclosure of personal use on your SEC reports, that kind of thing. So there's a lot of different things that we advise on as aviation attorneys. So this is the game that we play. And it's pretty unusual that you solve and completely get rid of all of these moles in a particular structure or transaction. One of them you might have to live with as your pet, or just ignore him when he's digging holes in your backyard and live with it. But we do try to solve for as many of these problems as we can. So this is our update on aircraft income taxes. And this is a question we get all the time. Can I deduct my aircraft expenses? And the answer is yes, but only if you're using it in a trade or business. And some of you might have heard that that phrase before, trade or business. It's a term of art in the tax code, and it references an activity for producing income which is regular and not episodic, and it's being employee is kind of a prototypical example of a trade or business, but manufacturing, providing professional services, those are all trades or businesses. And so when people ask us, can I deduct my aircraft expenses? We say yes, as long as you're using it in a trade or business. The next step we get to is we have to advise clients, well, is purchasing and operating an aircraft an ordinary necessary business expense in that trade or business? Which is a different question altogether. And it's one the IRS asks you all the time and challenges all the time if you end up in an audit. We ask 2 questions. One, is air transportation required for your business? And that's very often the case. Everybody flies for their business purposes to destinations in state or out of state. So that's usually very easy to meet. But the second question is a little bit harder. Is the need only met by private aircraft? Do you need this private aircraft in order to conduct your business effectively? Is it an ordinary and necessary business expense? And there are several things to think about here. Think about whether you're purchasing the appropriate size aircraft for the business missions that you're going to do. Think about whether you're going to be using the aircraft enough in your business to where a purchase makes sense. Is it necessary that you buy an aircraft rather than charter an aircraft for the few hours, just a handful of hours a year that you're using it? And can you defend it as a common business practice in your industry? So there's a number of questions to think about. How do you answer these questions when you are going to show and prove to an IRS auditor that is your need for air transportation can only be met by private aircraft. And you got to be prepared to make arguments for why the aircraft is an ordinary necessary business expense. And sometimes people get confused. I apologize. On the left here, I've got some items that are checked and a couple boxes that are unchecked. And you're not going to be able to make all of these arguments for your particular situation. So I haven't checked all the boxes, but these are the types of arguments that you want to make for the IRS to show that your use of the aircraft is ordinary and necessary. One would be we can't risk the cancellation of a flight. There may be an airline strike or an airline bankruptcy, and the flight that I want to take to my very, very important business meeting got canceled. We can't risk that. I see a moderated question there, and it looks like more of a comment, and I want to call it out because it's good for you. IRS challenged me on whether use of my aircraft was ordinary and necessary, and I won in court. Yes, absolutely. You can win in court if you're prepared to make these arguments. So don't worry about people losing this argument all the time. That's not the case, but you do have to be prepared to make these arguments and show how the aircraft is an ordinary and necessary business expense. Another argument we see from our clients frequently is their travel they have to make to, and that video from Catalina Imaging showed that they have trips to remote locations, remote hospitals where there's little or no airline service. How are you going to get to those remote locations? You can't do it on the airlines, and driving the car is lengthy, not to mention, not safe all the time. Using a private aircraft to conduct those trips is much more productive for you and can expand your business. So that's a great argument you can use. If you need to prepare for a presentation at the other end or get work done, that's another argument for having a private aircraft. You can't work on confidential matters on the airlines. That's just not a practical way to work these days, even if you're sitting in premium class or something. If you have missions to multiple sites and itineraries that can't be done in the commercial airlines, if you got to be in Boise in the morning and Wichita, Kansas in the afternoon for your meetings, you can't do that type of itinerary on the airlines. So that's another reason why private aircraft allow you to be more productive and do the missions that you need to do. Allowing for changes in your itinerary, carrying a number of folks, large numbers of people. Airlines run very full these days. If you're carrying 6 or 8 people around and you got to make changes to your itinerary, you're not going to be able to find 6 or 8 open seats on the next flight. Commercial airlines just operate too full these days in order to do that kind of thing. And sometimes we have, clients that have parts or equipment that can't be carried on the airlines or shipped as cargo. They're either too delicate or they're on the list of prohibited items to where that's an issue. So there's a lot of arguments you can make for your aircraft being an ordinary necessary business expense, but you've got to think about it and be prepared to make those arguments if the IRS should come knocking. I want to talk a little bit about a different class of deductions or 2 classes of deductions that were only available to individuals, but they were repealed or at least temporarily suspended under the Tax Cuts and Jobs Act. So I mentioned deducting an aircraft if it's an ordinary and necessary expense in a trade business, that trade business phrase. There were 2 other sections of the code. One was Section 212, which allowed for individuals only, not for corporations or entities, but for individuals only, you could deduct expenses for the production of income. And a production of income activity is something less than a trade or business. It's not professional services firm. It's not manufacturing widgets. It's more episodic in nature, or you have a bunch of passive real estate investments that you don't participate in, or a huge portfolio of equities or bonds that you manage. You might have to travel to look after those investments, but they're not really a trader business because you're not a stockbroker, you're not trading those, but you're still looking after investments. Those are the type of production of income deductions that used to be available for individuals, but the Tax Cuts and Jobs Act repealed that Section 212 deduction for individuals. The other thing the Tax Cuts and Jobs Act did was repeal the miscellaneous itemized deductions. And so that was a change to Section 67G. And I mentioned a couple minutes ago that being an employee is kind of your prototypical trader business. You show up to work every day, you get wages and salary, and that's considered a trader business. But there used to be a category called unreimbursed employee business expenses that were deductible. So say you were an employee, say you were a CEO of a big company, but you bought your own aircraft in order to travel for business. And assuming it was an ordinary necessary business expense, assuming you bought that aircraft and paid for it yourself, that would be considered an unreimbursed employee business expense and potentially deductible. It was in the category of deductions that are called miscellaneous itemized deductions. And in the case of individuals, you could only deduct them to the extent they exceeded 2% of your adjusted gross income. But the Tax Cuts and Jobs Act essentially suspended those miscellaneous itemized deductions, one of them being the unreimbursed employee business expenses. So you don't have that deduction anymore. So the consequence of this is that it's harder for individuals to be able to deduct their aircraft if they're not using it in a trader business or don't have it in their corporation or their LLC that's conducting a trader business. So I do want to point that out. There's some higher thresholds here. I don't know if anybody's had that discussion with their accountants yet, running it on preparing the tax return about deducting aircraft expenses. So it's something to keep in mind. I want to shift a little bit and talk about depreciation for aircraft because that is almost always a hot topic because depreciation is can save you significant taxes if you're eligible to take advantage of it. And I just want to do a few slides here of introduction about what depreciation is and what we're talking about here. The first category is market depreciation. That's the comparison of what you bought the aircraft for from the manufacturer or the third-party seller to what the aircraft's worth in the market right now. Aircraft are life-limited assets. They have maybe 20 or 30 years of life, so they don't last forever, so they are going to depreciate in value over time. The second category is book depreciation, which is just a financial accounting concept. So you have an acquisition cost, and then purely for purposes of financial reporting, you assume a number of years that the aircraft is going to last and what its residual value is or scrap value. And most often that book depreciation is just taken straight line over maybe 15 or 20 years. It has nothing to do with the actual market value. It's just a conservative accounting estimate. What's most interesting for us is tax depreciation, what you get to deduct on your as an expense on your taxes. It's intended to reflect the wearing out and reduction in value over time, and used to be intended sort of to match your tax deductions with the income that your asset produced, but it's not really related to reality. We have accelerated depreciation for many classes of property, and for aircraft in particular, we now have or have had since 2008 bonus depreciation for the first year, and under the Tax Cuts and Jobs Act, 100% bonus depreciation even on used aircraft. So and the categories of the amount of depreciation available has expanded significantly. These slides compare the types of depreciation. Here we have a market depreciation chart that we came up with using the Conklin and Dedecker industry guide showing that piston aircraft probably depreciate more rapidly than jet or turboprop aircraft. So that's market depreciation. This slide here goes into kind of the bubble we saw, I don't know, 10 or 12 years ago on turbine aircraft, where there was a huge bubble along with a bubble in asset prices driven by easy credit and a lot of other categories. And you see with the Great Recession, it returned kind of back to that mean there. And this slide illustrates how different the three categories of depreciation are. You've got the market line, the blue line at the top, you know, what the accountants put on their books, and the tax depreciation, which is accelerated. So it's kind of an incentive for folks to invest in capital assets. So basically for aircraft, they fall into a couple of different asset classes, asset class 00.21 and asset class 45.0. So those, depending on your usage of the aircraft, aircraft used in business, or if they're used primarily for commercial air operations, they fall into a different asset class. And over here on the right, we see there's two types of depreciation systems under the code. There's the accelerated maker's depreciation, and then there's the ADS, which is also known as straight line depreciation. And we typically see clients use 5-year makers for their Part 91 aircraft, and 7-year makers for aircraft that are used primarily Part 135. So again, it's probably the predominant use of the aircraft. Some people have a business aircraft that they put out for charter every once in a while. If it turns out that that aircraft is used primarily in charter, you would use the longer 7-year maker schedule rather than the 5-year maker schedule. So it turns out 5-year makers for Part 91 aircraft, 7-year makers for Part 135 aircraft, and then there's what they call the convention. When you place the aircraft in service, you don't get a full year's worth of depreciation in that year you place it in service. You either place it in service as if you had purchased it at the 50% point in the year, the mid-year convention, or if you're closing in the fourth quarter is where we most often see this, you end up in a mid-quarter convention for the depreciation rate. So your depreciation in the first year can be fairly limited. I'm talking about the regular depreciation schedule, not bonus depreciation, so caution there. I see a question here about something called recapture, and I'll get to that in a minute, but that is a good question because this is tax depreciation that you write off. It's a deduction that you use against your ordinary income, and when you sell the aircraft or stop using the aircraft in business, you could end up having to pay income taxes on the amount that you sold the aircraft for, or when you stopped using the aircraft primarily in business. So I'll get to that in a minute. So that's a good question there. I mentioned that we have bonus depreciation. We've had bonus depreciation in one form or another since 2008, but right now, even for new and used property, we have the ability to write off 100% of the purchase price during the first year, and that's available through the end of 2022. As long as you place it in service before 2022, you get that 100% bonus depreciation. Applies to
Hey, Nate.
Go ahead.
I want to make sure that I understand this. There's no mid-year or end of quarter cap on this depreciation the way that it works now. If you place it in service in December, you still get the 100% bonus.
Correct.
In that year.
Okay. Yeah, that's absolutely correct. Good question. Good question. Yeah, the mid-year, the convention just applies to the normal depreciation schedule. Bonus, no matter what time of the year you place it in service, you get bonus for that particular asset there. So it applies to new and used property. It also applies to capital improvements to property. So if you're upgrading your avionics, even if they're not new avionics, if they're refurbished avionics, that type of property added to this bonus depreciation eligible property would be able to be depreciated. There's a couple rules there that to keep people from kind of buying and selling assets or turning property. If you previously owned an aircraft or had a depreciable interest in that property before, I think it was September 27th, 2017, then you can't take bonus depreciation. So if you had a personal use aircraft and you owned it for 10 years and now you're thinking about using it in business, you don't meet the acquisition date requirement, and so you don't get bonus depreciation. But that's an interesting thing there, because potentially if you acquired an aircraft, after September 2017, and it was just a personal use asset, and you convert it to business use, there is the potential for bonus depreciation there. So that's an interesting thing there. Here's an important thing, this fourth bullet here. You need to be eligible for maker's depreciation and remain eligible for maker's depreciation during the entire depreciation schedule. So I mentioned they have you have makers accelerated depreciation, the 5-year and the 7-year makers. And to qualify for 5-year or 7-year makers, you have to have more than 50% qualified business use. And that qualified business use is, think of it as, real business use rather than, leasing the aircraft to a related party or using the aircraft to compensate your employees, kind of those, iffy business use cases. If you have at least 50% real business use in your trader business, then you're going to be eligible for maker's depreciation. But if you fall below that 50% qualified business use threshold, during any of those 5 years, you could suffer what's called recapture. And in that circumstance, what they do is they make you switch to the straight line method of depreciation, and all the bonus and maker's depreciation that you took previously, they treat you as if you had placed the aircraft in service under the straight line method. And if you happen to have taken the makers or the bonus depreciation, they recapture that amount. So they basically switch you to straight line. And if you've taken more than straight line, you've got to you've got to claw that back and pay income tax at your ordinary tax rate on that amount. So depreciation can be an issue. So that's one thing you got to watch out for. You got to have more than 50% straight trader business use of your aircraft to keep in the maker's depreciation schedule and to hang on to your bonus depreciation. That's something really important that you've got to do. It's not like you can just use the aircraft in business 1 year and then stop using it in business and still keep the bonus depreciation. They're going to claw that back if you stop using your aircraft in that trader business. The last bullet there, we probably have a lot of people attending that are California income tax payers. California doesn't have bonus depreciation on the state return. So it's just the federal benefit only. On the state return, you just do the regular maker's depreciation. I don't know if there's any automobile or equipment dealers in the audience here, but if you have floor plan financing for boats, automobiles, farm equipment, you don't get to take bonus depreciation if you're using the aircraft in that particular trader business that has floor plan financing. We have clients that have floor plan financing and they haven't run into this issue yet because they haven't bought a new aircraft yet, but when it comes time to buy one, they don't have that ability, unfortunately. Probably don't have any regulated utility people attending, but I could be wrong. There's also a similar rule in place for those folks. This is a chart showing kind of the calendar of when bonus depreciation is in effect. So it's a handy chart to refer to. Like I said, we have 100% bonus depreciation through the end of 2022. So that's that green solid line there. And then for the year 2023, that green solid line there, it says we have 80% bonus depreciation. So you get to write off 80% the first year, and then the remaining 20% you get to deduct on the regular maker's schedule. Similarly, in 2024, you get 60% write-off in the first year, 40% gets written off on the regular schedule, and so on. It's 40% and then 20%. And then in 2027, bonus depreciation is gone. You can only deduct the aircraft based on the regular maker's schedule. I should point out here that you can get 100% bonus depreciation in 2023 if you signed a binding written contract before the end of 2022. And that's kind of a technical term, what a binding written contract is. This is quite a few years away. 3 years away, I think. But if you're thinking of purchasing an aircraft at that point, you'll want to remember that that there are some limits on bonus based on the timing. And this slide here goes into the definition of which property are eligible for that dotted line extended period of placed in service. Certain aircraft, they've got to be more than $200,000 aircraft, take more than 4 months to manufacture, and you have to make at least $100,000 deposit on it. So it's basically certainly all business aircraft, turbine-powered business aircraft, so it's probably not an issue. If you're using the aircraft primarily Part 135, those dotted lines, if you're primarily used in the trader business of let's say charter, you only get a certain percentage of the purchase price that's eligible for bonus. But we don't know exactly what that means. We're assuming that it's primarily used in charter, but not exactly sure. But again, these are for the dotted lines in the out years, so these aren't going to apply for quite a few years. And then here's a slide on what a written binding contract is, and again, this applies later, so I'll give short shrift to this one. And this is just a comparison of bonus depreciation versus the regular maker's schedule here, the 5-year maker's schedule. So it's 100% write-off in the first year versus a write-off over time. You still get to write off the same $3 million in this example purchase price. It's just that you get to take it earlier. You get to take it all up front in the first year rather than over time. Writing off the aircraft, and here's that mid-year convention. So it's 5-year makers, but it's 1, 2, 3, 4, 5, 6 tax returns that you actually take the depreciation on. So you still get $3 million. You don't get to depreciate more than the purchase price. You just get, so it's not a bonus over and above whatever the regular purchase price is. It's just that you get it sooner. They still call it bonus. So the way to analyze bonus depreciation, whether it's worth it to you and how much you might be losing if you don't get it, is the net present value. And it's the net present value of the tax savings that you get. Think of bonus depreciation as kind of an interest-free loan that you get from the government. So you'd rather have that loan earlier than later. And the timing and the value of the timing depends on your cost of capital. That is, how much you're paying to on your money, or the return that you get on your money that you're otherwise not paying to the government. So I've listed it here just as an example as 4.5%. Probably not very many of you are making 4.5% on your safe investments, but a 35% consistent tax rate. And that's close to what individuals are paying federally right now. So if you do a net present value analysis comparing $3 million now versus the present value of that depreciation deduction, it's about a $222,000 net present value savings. But you have to multiply that by your tax rate. And the net benefit to you of 100% bonus depreciation versus no bonus is only about 2.6% of the value of the aircraft. So if you're thinking about, purchasing an aircraft, I got to buy this $3 million aircraft, but it's bonus depreciation eligible, got to close this year, I'm going to pay $200,000 more for it. Well, you've actually come out behind because the net present value of that is only $77,000. So So the lesson here is not really to chase aircraft just for bonus depreciation. You've got to actually do some calculations to figure out if it's actually worth it. Here's another slide that illustrates for corporate taxpayers whose income tax rate is 21% now under the Tax Cuts and Jobs Act, using a different tax rate, lower than 35%, the present value of bonus depreciation goes down significantly. The previous slide, it was 1.6%, 2.6% of the value of the aircraft. Here it's 1.6%. So with a lower tax rate at the corporate level, and I'm talking about C corporations here, not S corporations, the bonus depreciation is kind of less of an incentive to invest. So the corporations, C corporations seeking a tax shelter because their tax rates are high, that incentive has kind of gone away. There are some reasons why bonus depreciation may not be worth as much to you as the calculations in the previous slides, because there are some restrictions on being able to deduct what they call excess business losses for individuals. There's also limitations on businesses being able to deduct net operating losses. And I'll get into those a little bit more. If you're using the aircraft just to lease out to third parties or to charter it, there might be a passive activity loss limitation that might apply. And the third bullet here, I mentioned if your business use is under 50%, you get recapture there. So all these different rules you have to keep track of to figure out if bonus depreciation is something you should chase. It's probably not something you should chase. It's not worth millions of dollars in benefit to you, but more likely a small percentage of the purchase price. But you've got to do the analysis, get a spreadsheet out, and figure out what the benefit is to you. I see a question here that can you choose to take less than 100% in year one of bonus and depreciate the balance? That's an excellent question because, and intuitively, it sort of makes sense. Hey, if I can get bonus, I can take anything less than bonus during the first year. Makes sense to me, but unfortunately, the tax code is not set up that way. It's kind of an all or nothing proposition. So if you take bonus depreciation actually automatically applies unless you elect out of it, you make a choice on your tax return to take the regular maker's schedule. So it's like you either get 100% bonus depreciation or elect to take the maker's schedule. You can also elect to take straight line. You can elect to take makers, and then you can elect to take straight line if you like. But those are basically the only options that you have for depreciation. The IRS doesn't let you pick, say, hey, I want to deduct 77% this year since I can't take 100%. No, they don't let you do that. Excellent question there. Yeah, bonus depreciation, everybody gets it now, so maybe it's less of a red flag, but in the case of a very expensive aircraft, it can put you in a big loss situation. So it still might be a red flag for auditors at the IRS. So probably the audit exposure probably hasn't reduced very much, even though everybody's getting bonus depreciation now. One thing that you have to be aware of is if you have the aircraft in an S corporation or an LLC, that files its own tax return, and you've got entertainment use of the aircraft by significant owners of the company or the CEO, that depreciation is the type of deduction, is one of the deductions that's subject to disallowance based on that personal entertainment use. So using the aircraft to go on a vacation or go golfing or go to watch an NFL game or a college football game, that's the type of entertainment use that the IRS will disallow deductions for. There is a good rule here in 274-10, that regulation 10D3, that allows you to elect straight line depreciation, but only for the purposes of computing the disallowance. And it's a neat strategy to use to take that straight line in year one, but the regulation says if you're not taking any, actually taking any depreciation in year two, you take, your disallowance is zero. So it's a way of, excuse me there, sorry, phone ringing. Sorry about that. So it's a way of limiting the bite of entertainment disallowance for depreciation. This slide goes into a little bit about, it's actually section 280 capital F, which governs the rules for listed property. Aircraft are listed property. And this contains the rule that I mentioned earlier, that you have to have at least 50% qualified business use in order to be eligible and remain eligible for makers and therefore bonus depreciation. And there's a number of ways that you can fall outside of makers depreciation. If you're leasing it to a 5% owner or a related person, or there's too much personal use by that 5% owner, or you're giving it to non-5% owners and you're not imputing income to that person, you can fall out of makers really quickly there. You might be able to, if you're leasing the aircraft to a tax-exempt entity or primarily using the aircraft outside the United States, you can also fall out of accelerated depreciation, bonus depreciation.
Hey, Nate, I see a question there about 179.
Oh, okay. So section 179, yeah, 179 was expanded and extended under the code, but 179 is an election you have to make, whereas bonus depreciation just automatically applies. And the dollar limits for 179 are much lower. I don't think there's any reason why you would take 179 rather than the bonus depreciation. Now, in future years, where bonus depreciation disappears, you will have to. It may be advantageous to use 179 deduction there, but right now it doesn't make sense to do that. This goes into the leasing company trap. If you're leasing to a related party, that's not necessarily business use qualified under Section 280F. So if you're thinking about doing a lease to a related party and that's going to be qualified business use to get your bonus depreciation, you got to really be careful of that. This slide, I really need to make some points about this one, because 1031 tax-free exchanges, and probably a number of you have heard about these for real property. They're still available for real property, but for personal property such as aircraft, they repealed permanently 1031 tax-free exchanges, and that was effective as of January 1st, 2018. So this year, you can't do a 1031 exchange on aircraft. So it used to be, this was a good way to avoid the recapture scenario that I talked about a little while ago. So you purchase an aircraft and you take depreciation, and then when you sell it, you have to pay recapture on it. But 1031 allowed you to roll your proceeds from the sale of that aircraft to a new aircraft, and then you didn't have to pay recapture. So 1031 exchanges are gone. I will go back to the previous slide. I'm not sure what, somebody had a question about the previous slide.
Rick, you asked the question.
Yeah, if you need something, I'm happy to provide a copy of this presentation to anybody who needs it. So if there's a specific question on this slide, let me know. But I don't need to go back, so you can copy everything down. We'll send you a copy of this presentation if you like. So tax-free exchanges are gone for aircraft. And like I said, bonus depreciation is gone, or starts to be reduced in 2023. And then it completely phases out in, what is it, 2023, 24? 2027, there's no bonus depreciation. You just depreciate on the regular maker schedule. So what that means, if they don't change the law, you don't have bonus depreciation anymore, is that you sell your aircraft, have the recapture on that, and then you don't get bonus depreciation. So right now, if you sold an aircraft and purchased a replacement aircraft, the bonus depreciation on the replacement aircraft would offset your recapture on the sold aircraft. So it's kind of no harm, no foul right now. With the repeal of 1031, we have bonus depreciation, but bonus depreciation is going away in future years. One advantage of 1031 being repealed and having bonus depreciation now is that you don't have to have aircraft inside the same taxpayer to do an exchange. So it used to be if you had one company with an aircraft, you had to do a 1031 exchange with that same taxpayer, but it may not make sense for you to have the aircraft owned in that same entity. So you can kind of mix and match taxpayers. You can move it around. So it does provide you some more flexibility having the bonus depreciation right now. But yeah, in later years, say 2024 and in the future, the lack of 1031 exchanges is really going to make it painful to upgrade aircraft because you got to pay that recapture. So it's actually going to provide a disincentive to invest in aircraft, unfortunately. I know I've been kind of long-winded here, and we're getting towards the top of the hour, but there's really a lot to discuss with these income tax issues, and I don't think I'm going to get to the multi-state sales and use tax stuff. We are scheduled for 30 minutes or 60 minutes, right, Tom?
Yes, unless everyone on at the current webinar sends us a text that says continue, which I'll let you go as long as you want, Nate.
Yeah, no.
Normally these are an hour long, but
yeah. No, I'll try to make it not too butt wearying for you. So here we go. Excess business loss limitation. So this has a huge impact on bonus depreciation. So it's code section 461. And this is kind of one of the things they put in the tax code or the tax law to make the math work for the 10-year budgeting or whatever they had to do, whatever rules they had to follow in Congress. 461L limits excess business losses for individual taxpayers. And excess business loss is defined as losses from trades or businesses of the individual or their allocable share of trades or businesses of S corporations or partnerships. So if you have an S corporation or a partnership that passes through a significant loss to you on your K1, or if you have, say, a Schedule C business that creates a loss in that first year, Section 461L says that you are limited in the amount of business losses you can deduct on your personal return in that year. In the case of a single taxpayer, your excess business loss deduction is limited to $250,000, and for a married couple, it's $500,000. So the way this can come up is, say you have an S corporation trade or business, and it makes lots of money, and you bought an aircraft in there. And it's ordinary, necessary, and appropriate to that business, but you take the 100% bonus depreciation, and let's say as a result of that bonus depreciation, the K1 from the S corporation kicked out to you at the end of the year shows let's say a $2 million loss. What 461L says is that $2 million loss, you can't take that all in the first year. I'm assuming that you have other income that you can offset it against in that year. You can only take $500,000 of that loss in that first year. The remaining $2.5 million of loss has to be carried over into the next tax year and treated as what they call a net operating loss under Section 172. So the effect of this is to limit the benefit of 100% bonus depreciation in some situations. And they also changed the rules for net operating losses, for individuals and companies. So right now, net operating losses under the Tax Cuts and Jobs Act, you can deduct only up to 80% of your taxable income for each year. The balance you have to carry over to future years. And you can't carry over or carry back net operating losses to previous tax years. So say you had a big loss this year, you can't carry it over to last year, say when you had a really super good year. So that's a change. So this is an important limitation. If you're buying an aircraft to use in your trader business and it creates a big loss for your trader business, that loss probably isn't deductible in that first year unless you have income for other trades or businesses that can absorb it. Very important limitation here.
Nate, you got another question.
Yeah, there we go. Can the $2 million loss offset other K1 income without applying the 500? Yeah, that's the issue. So excess business losses, so you kind of add up all your losses from your trades or businesses or that are allocable to you under S corporations or LLCs in which you're a partner. And so it's your net overall loss from your all your trades or businesses. So yeah, you can take the balance. So if you had a $2 million loss because of bonus depreciation, if you've got other trades or business that have income that can absorb that loss, then yeah, that's a good strategy to use to avoid that the bite of that. So that's a good thing. But one thing you can't offset it against is say you get shares of stock or bond dividends or capital gains on something else that you sold. Those aren't trades or businesses that you can offset against. It's only that $500,000 or $250,000. Grouping elections, that was the next question there, and that's related to passive activity loss limitations. So if you and that's a passive activity for an aircraft is the way that comes up is if you're leasing it for charter or leasing it to a third party. That's what's considered a per se passive activity. You can't materially participate in the activity of leasing an aircraft. So you have to. The only way to get around that loss limitation, the passive loss limitation, is to be able to group it with some active activity that you materially participate in. And you can do that only if it's insubstantial enough to that active activity. And I think there were some proposed regulations on it, whether it was insubstantial, but that's right now with a fixed percentage about whether it was insubstantial, but right now it just says insubstantial in the regulations. So that's what you'd have to show in order to group a leasing activity to avoid passive losses. So that's the answer to that question there. And I see someone is really trying to test me here with section 199A. 199A is S corporations, and there's what they did in the tax code was kind of to level the playing field between S corporations that don't pay a corporate level tax and the C corporations that pay a 21% corporate tax, which is less than the individual marginal rate. So there's some deductions and benefits under section 199A for S corporations. So yeah, that's all. You have to do the analysis on all of it to figure out whether the bonus depreciation is eligible for section 199A. So thank you. I don't know whether to thank that person or curse that person for that question.
That's my friend Tom from Maryland.
Okay, yeah, no, because 199 is.
No, I'm sorry.
No, that's fine. I'm just being tongue in cheek there. I feel like I'm on the hot seat with my tax professor or something. But 199 is probably the most complicated part of the code right now. It's just nightmarishly complex. Probably as complex as the partnership regulations. And everybody's situation is different. So yeah.
So just to give you a heads up, Nate, we've reached the 1 hour mark.
What's that, Tom?
We've reached the 1 hour mark. So how much longer do you think it'll finish to take? take to finish this section?
I just got a couple more slides here, yeah.
Okay.
I do want to talk about hobby loss deductions, which have taken on some new importance under the Tax Cuts and Jobs Act. We've had Section 183 since I can't remember when, but it's been 40 years probably. If you're engaging in an activity that not for profit activity, if you're, I think the prototypical example they had in mind when they passed this law was the horse racing business. You buy a bunch of horses and they run. They always run out of the money. They're very expensive to acquire and to maintain, and employ trainers and house and everything and feed. They never make money. So if you're in a business that never makes money, the losses from those businesses aren't going to be deductible against your other income, because they think that you're really spending money to enjoy horse racing rather than spending money to be in the business of horse racing. Under the Tax Cuts and Jobs Act, they changed the rule. The rule used to be that the income from your hobby used to be offset by deductions from that hobby. So to the extent that your hobby income, you had hobby income, you could deduct hobby deductions, so you wouldn't pay any tax. You couldn't deduct loss, but you wouldn't have any tax on your hobby income. But as I said earlier, the Section 67G was amended to get rid of miscellaneous itemized deductions, and hobby deductions are considered miscellaneous deductions. So the effect is that you end up with a gross income tax on your hobby income. So hobbies are something hobby treatment is something you really, 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 really want to avoid now under the Tax Cuts and Jobs Act. There's a couple slides here. I want to go on this one first, the limitations on business interest deductions. This is 163J. So for business interest, your deductions are limited to your business interest income, 30% and plus 30% of your adjusted taxable income, plus your floor plan financing interest. So they reduced the corporate tax rate to 21%, but they also reduced the business interest deduction as a result. So the way this comes up is if you buy a very expensive aircraft, use a large loan to acquire it, and have large interest payments, those interest payments, to the extent they exceed your 30% of your adjusted taxable income, might not be deductible. So to spend all that interest to acquire the bonus depreciation deduction may not be worth it, because the interest may not be deductible. Well, it's not disallowed, but it's carried over to future years. So it's some limitation on business interest deductions. And in future years, the definition of adjusted taxable income goes down, and so as a result, the amount of deductible business interest goes down as well. So this is another thing that you have to keep an eye on. Last thing I wanted to say here was, this is a little bit of an unknown here. If you have a company, let's say an S Corp or a multi-member LLC that's taxed as a partnership, and you're incurring expenses for commuting the employee, among his residences or from his residence to a place of business, it says the change to Section 274 says that that kind of expense is no longer deductible. But even if you're imputing, there's a lot of open questions there. Who is it applicable to? Is it applicable just to one residence or multiple residences? Or what if you have multiple places of employment? Even if it's, do you have to have a security program in place in order to show that that the transportation is necessary for the safety of the employee? And here's the key thing: if you impute income to the employee for that fringe benefit of traveling, is it still non-deductible? We have a similar spousal travel rule in Section 274, which doesn't apply if you impute income, but we don't know the answer to this. So watch out if you're buying an aircraft just to commute to and from your business. from your residence to your place of business, because it may turn out to be non-deductible, but we don't have guidance from the IRS on that. That's about what I have here on income taxes. There's some other slides on multi-state sales and use tax, which probably won't make a lot of sense.
The one thing I'd like you to do is
Go ahead.
shift to the end so all your contact information is available. I know at the end of this presentation, you've got or somewhere in this presentation, you've got a phone number and and a website.
Yep.
Okay.
Yeah, so this is our mission statement. We represent end users of aircraft in tax and transactional issues. We've got a number of attorneys. We're all up in the Seattle area. And then our contact information is here at the end. We're up in Bellevue, Washington, east of Seattle. Probably the majority of our clients are in California, as it turns out. So we deal with Tom and all the time, and he does a great job for our clients. So yeah, if you have any questions about this presentation or have any other aviation specific legal advice that you need, give me a shout. And thank you, Tom, for inviting me to do this, and I enjoyed speaking with you.
So Nate, there's actually a new question that came in, so I'll make sure I get that to you. And I see that came from, I think, Devin. You've got Nate's information right there. Contact him directly and he'll get you the answer to that question. As usual, Nate, thanks for the great presentation.
You're very welcome, Tom. Good
let everybody know that we recorded all of today's event and it will be live on our website within 48 hours so that you can go back and see it again. And all of you that are live on Facebook or Instagram, you'll be able to collect this stuff at our website. And I can see that there's 109 slides in Nate's presentation, so he has quite a bit of other stuff. So if you want us to bring him back and continue on his presentation on ownership structures, just contact Kelsey and she'll work it out with Nate. Other than that, thank you, Nate. Thanks, Kelsey, for the great job again. And I am ending this event.
Thank you, Tom.